Have you ever looked at the financial markets and just felt lost? One day it's up, the next it's down. It feels totally chaotic. But what if I told you there's a hidden rhythm to it all? A pattern that, once you see it, can totally change the way you look at the economy.
You know the feeling, right? You're watching the headlines, trying to make sense of the noise. It can feel completely random, like trying to predict a lightning strike. But here's the thing. Maybe we're all just looking at it the wrong way.
And here's the secret. All that daily up and down, that's just the financial weather. It's short-term, it's volatile, and yeah, it's pretty much impossible to predict. But underneath all that noise, the economy moves in a much grander, much more predictable cycle, just like the changing of the seasons. And if you can learn to read those seasons, well, that's a game changer.
So, what are these economic seasons? It's actually pretty simple. Just like in nature, the economy has a rhythm. It cycles through 4 distinct phases: a time for growth, a peak, a slowdown, and then a time for renewal. Let's break them down.
First up, we have expansion. This is the economy's springtime. Everything is coming to life. You see the gross domestic product, or GDP, start to climb. Unemployment drops because companies are hiring. And because people have jobs and feel confident, they start spending again. That optimism is contagious, and businesses start investing, building, and growing. All that growth eventually leads us to the peak. Think of this as the economic summer. Everything is booming, growth is at its absolute strongest. But just like a really hot summer day, the economy can start to overheat. Things get a little too hot, demand starts to outrun supply, and you begin to see inflation creep up.
And after summer, you know what comes next? Autumn. In the economic cycle, we call this the contraction phase, but you probably know it better as a recession. This is when things start to cool off. GDP growth slows way down and might even go negative. And unfortunately, as companies see less demand, they cut back on production, which leads to layoffs and rising unemployment.
Finally, we hit the trough, the economic winter. This is the low point of the cycle. Activity is at a standstill and things can feel pretty bleak. But here's the crucial part. This isn't the end, it's the turning point. It's from this very bottom that the seeds of the next spring, the next expansion, begin to grow.
Okay, so this is all really interesting theory, right? But what does it actually mean for you? Well, understanding these seasons isn't just an academic exercise. It's an incredibly powerful tool that can help you align your own strategy with what's happening in the economy instead of fighting against the current.
And the impact on your investments? It can be absolutely massive. Just look at this. Historically, stocks have delivered their best returns. We're talking an average of over 20% during that early cycle, that economic spring. But see how that changes? During a recession or winter, those returns have typically gone negative. This shows you exactly why knowing what season you're in is so critical.
This idea leads to a really smart strategy called sector rotation. It's basically about shifting your focus to the industries that are most likely to do well in the current economic season. So in that spring phase, things tied to growth, like financials and real estate, tend to shine. But as the seasons change and we head into autumn, investors often pivot to more stable areas, like healthcare, or companies that sell things we need, no matter what, like toilet paper and toothpaste.
You can basically group these into 2 big buckets. You've got your cyclical sectors. Think about things you buy when you feel good about your finances, like a new car or a big vacation. They do great when the economy is expanding. And then you have the defensive sectors. Think utilities and healthcare. People need electricity and medicine no matter what season it is, right? That makes these sectors much more resilient when things slow down.
Okay, so we have our map of the 4 seasons. Now for the million-dollar question. Where are we on that map right now? Let's use this exact framework to figure out where we stand here in late 2025.
Well, the general consensus among economists, looking at all the data, is that we're in a mature, late phase of the cycle. Think of it like late summer. The sun is still out, but you can feel that first little chill in the air that tells you autumn is just around the corner.
So let's look at the evidence. Clue number 1, the federal funds rate. It's now sitting between 4 and 4.25% after the Fed made its first rate cut this year. Now, why is that a big deal? Because central banks usually only start cutting rates when they're worried that economic growth is starting to weaken. It's a classic late cycle move.
Clue number 2 is the overall pace of growth. The projection for U.S. GDP growth this year is just 1.6%. Now that's still growth, which is good, but it's a definite slowdown from the faster pace we saw in previous years. The economy is clearly losing a bit of steam.
And finally, clue number 3, the job market. The unemployment rate is expected to tick up to 4.5% by the end of the year. Again, that's still a pretty low number historically, but what's important here is the direction. The trend is now moving up from those rock-bottom lows, and that's another hallmark of an economy that's past its peak performance.
So when you put all these pieces together, the Fed cutting rates, slowing GDP, and unemployment starting to rise, the diagnosis becomes pretty clear. All the signs are pointing to a late cycle phase, and that means the risk of an economic autumn, a slowdown, is higher now than it's been in years.
So, what do you do with this information? The goal isn't to run around making frantic short-term bets. Not at all. It's about using timeless, proven strategies to help you navigate whatever the road ahead might bring.
And this is maybe the most important point of all. Being aware of the cycle is not the same as trying to time the market. Market timing is trying to guess the daily weather, predicting the exact top or the exact bottom. And guess what? Almost nobody can do it consistently. The proven strategy is time in the market, staying invested for the long haul to capture growth across all the seasons.
And if you need any proof of that, just listen to this incredible statistic from Bank of America. If you had invested since 1930, but you missed just the 10 best days of the market in each decade, your total return would have collapsed from over 17,000% down to just 28%. It's mind-blowing. The best days often pop up right after the worst ones, and you have to be in the game to catch them.
So let's wrap this up with a simple, actionable strategy. Being cycle-aware isn't about panicking. It's about preparing. First, understand the season we're in. Second, focus on high-quality companies with solid finances that can weather any storm. Third, make sure you're properly diversified. Don't put all your eggs in one basket. And finally, check in on your portfolio and rebalance it regularly to make sure it stays aligned with your long-term goals.
At the end of the day, the business cycle isn't something you should be afraid of. It's just the map of the economic terrain. It helps you see what's ahead. So the real question isn't what the next season will be. We know it will come. The question is, now that you have the map, how will you prepare for it?